Hello and welcome to Credit Shift News and Update. This week I'm Paul Sweeney, co-founder and chief strategy officer here at Webio, and today I am again joined by our CEO and co-founder Cormac O'Neill, and we will be exploring Aidan Cormac, and we're going to be exploring some of the news, the stories, the events, the reports and trends in the credit industry. As usual, it's kind of crazy times everywhere, but Cormac, a hell of a week for us again. I mean,
it's been crazy, Paul. A hell of a month. Last week was crazy busy, but the month in general, February was really, really busy. I mean, we signed a number of, from a Webio point of view, just thinking solely about Webio here, we signed a number of really great new customers. Delighted with that. So, we've seen a real pickup in activity in our area in February. Even since the start of the year, it's been really, really busy, which is brilliant. Obviously we're very excited and happy with that. And also we came 15th in the Irish Great Place to Work for a small company. So that was just announced last week. So that's pretty brilliant for us to achieve such a high ranking, a small company, small but mighty, as we say, the team here at Webio. Yeah, small but mighty. So well done to everybody at Webio that contributed to that. And that kind of just, came at a time when we're seeing an uptick in business, an uptick in new customers. So yeah, it's
easy to lose track of.
It is.
It's easy to lose track. I mean, there's so much happening, and there's so much to do when you're a company like us. It's always good just to take a moment and just be grateful for where we are. So let's kick off on some of the general industry news this week, Cormac. Consumer credit seems to be recovering with an 8.9% increase in January over the previous month. As the cost of borrowing fell, there was a commensurate rise in the number of mortgage approvals. And in the housing market, it was still, relatively speaking, a buyer's market. So asking prices have come down a bit. However, inflation is still high, and many people are also borrowing for food, energy, and clothing bills, even middle-income households. So 22 million people in the UK expect their finances to get worse in 2024, not improve. And with mortgage approvals rising, demand for consumer credit rising, and cash deposits in banks rising sharply, I think we're seeing maybe two different parts of the middle class responding to that.
Yeah, I think so, Paul. The one that surprises me there is that last bit you read out, and cash deposits rising sharply. So everything that I've been hearing is that consumers have been whittling away their savings. A lot of people save money over COVID, and they've been using that money to fund themselves. But my understanding was that those savings were now coming to an end, and that's probably why you're seeing an increase in borrowing and all the rest. So yeah, it's interesting to hear that their cash deposits are rising sharply, and maybe you're right. Maybe there is a split there.
I think we're going to come to this in another part of the show today. But again, this is the tyranny of averages. You see some people, just rounding up. Some people will do, maybe are at the end of their mortgages or have a fixed rate mortgage at a low level. 2 jobs in the house, and they're accumulating cash.
Yeah,
people with a very similar sort of house maybe have gone through the savings and are now at the point where they're looking for other avenues of credit, which brings us to the second part here of our opening. Credit cards. Credit card complaints have reached a record high in Q4 2023, with consumers lodging 5,500 complaints, of which 3,086, or 54%, were due to unaffordable or irresponsible lending. This is the highest level of complaints in a 3-month period in nearly a decade. And interestingly, nearly 3/4 of the complaints were brought forward by professional representatives. Now, this gets interesting. To quote the Ombudsman, lenders have a duty to support their customers, whatever their circumstances, and are obliged to help people who are struggling with debt. The Financial Ombudsman Service has over 7,500 complaints across all financial products of irresponsible and unaffordable lending, of which 70% were from professional representatives. Now, the uphold rate of these complaints brought by professional reps, which were resolved in this period, was 14%, compared to the 44% for consumers who brought the complaints directly to the Ombudsman. And the reason given for this were the complaints were poorly evidenced. I found that fascinating, Cormac.
Something just doesn't add up there to me, Paul. So first of all, if we just deal with that point, right? So we're talking about professional representatives that are bringing these complaints. Now, so if I'm reading this right, what we're seeing here is consumers are bringing forward a more professional complaint than professional representatives. Is that what I'm hearing here?
That is what you're hearing. And yeah. I think I'd like to also step into that a little bit more maybe next week, because I think this is some of the agencies not coming forward with the right backing, with the right amount of evidence to say when, those bills weren't paid, what were they told, when were they told it, who was the agent, whereas an individual might have kept all those details, but maybe they weren't passed on to the professional representative. Gotcha. But something seems broken there.
For sure. Well, we've had this conversation before, right? If you look at 54% of those complaints were as a result of unaffordable or irresponsible lending, right? So that needs to be solved at the front end of the credit cycle where you're giving out credit. And consumers need to be educated and clearly signposted as to what they're borrowing and the implications of it, right? We all know credit card is one of the most expensive forms of borrowing, right? That's pretty much fact. So consumers need to be educated at the time that, look, credit cards perform a necessary function. Nobody's arguing about that whatsoever, but that they're educated up front that these are high interest rate products if you do not clear your balance. That's just the way it is. So, I'm kind of surprised by that. Now, look, I think companies are trying to do a better job on that. But clearly we've got a bit of a gap to go here. We're not there yet.
I'd love to dig into that more, and I'm going to, because that's an opportunity to fix something that's obviously broken. The third thing on our kind of what's general news this week is new research from Lowell's says that nearly a third of adults don't know how much debt they owe. Other interesting numbers from that research were that 41% of people in the UK worry about debt every single day. 16% admitted ignoring their debt for at least a year, during which, of course, the debt further accumulated. And after receiving support from a debt expert, 35% claimed they instantly felt more comfortable with their finances, and 65% of people in the UK claimed they noticed an immediate difference within a month. So again, this is a lesson that we're hammering home over and over again. The hardest step is the first step. And just engaging, you probably get rid of an awful lot of unnecessary fear, unnecessary anxiety. There's people genuinely want to help you get out of that situation.
Yeah, absolutely. So look, a third of adults don't know how much debt they owe, or do they not want to know how much debt they owe. Come on. when you were starting with that, I was like, oh yeah, geez, I'm one of those third. Am I? Do I know? Or do I even want to know? Right? Do I want to know how much debt I owe? So maybe there's a subtle difference between not knowing and not really wanting to know.
Cormac, have you ever gone to an ATM and pressed the €10 button and wondered if your balance would handle it? You could have pressed balance first, but you pressed 10. You pressed the $10 first, right? We've all been there.
And look, the main point, Paul, it's a serious topic here. The main point is the engagement is key, right? So, 16%, I think you said, admitted ignoring their debt. You cannot ignore it. Like, it isn't going away. It just isn't going away. And, we know this. The sooner you engage, the sooner you start a conversation around dealing with it, That's the first step towards resolution. There's no two ways about it. This is something that you're not going to ignore, and it just ain't going away.
Yep. Okay, well, moving on, section 2, our section on fintech, buy now, pay later, AI, and related news. We look at this section to try and bring you just the general industry news, things that might have passed by your attention. This week, there's a big one. Klarna has set off a big flare into our world. Klarna's AI implementation is a decisive move towards efficiency, handling 2.3 million interactions and managing the majority of the customers' conversations. This shift reportedly equates to the workload of 700 human agents, improving accuracy, evident from a 25% reduction in repeat inquiries, and reducing problem-solving time from 11 minutes to just 2. Now, the AI operates around the clock and can communicate in 35 languages, and again reportedly providing 40 million cost savings to Klarna. Financially, Klarna reported a 22% increase in revenue and a significant 32% decrease in credit losses. Now, this is despite these positive trends, the company still reports a substantial net loss, though it was reduced from the previous year. Now, from our point of view, we know that this wasn't a simple point-and-click implementation. There had to be training, fine-tuning, and a host of other techniques to get this level of performance. It does, however, equate with results we are seeing elsewhere. And speculation from industry insiders is that Klarna will release an AI-powered shopping assistant very soon. So we could see Klarna going AI head to tail. I think, Cormac, we've been following Klarna now for a while. They're not a customer of ours. But as a kind of bellwether in the industry of what's happening, an interesting company.
Okay, so when I saw this first, when I saw their PR, first thing was, wow. Right? We know this business. This is what we do. Everything Klarna talks about here, we do this day in, day out, right? So I'm a Klarna customer. I use Klarna myself to every now and again to spread the pain. And I said, hey, I'm gonna go on there. I'm gonna check out their offering on their app, the Copilot, and it's good, right? I have to say, hats off to them. It is good. It answered my queries. I tried to probe it here and there to see what it would say, and it did it very conversational, quite professional. And yeah, I would say one of the better ones that I've seen in terms of a use case. So as you said, Paul, we know what's behind the hood on this one, and it is definitely not a point and click. There's gonna have been a lot of work put in behind the scenes to get it to where it is today, and that's fine. That's understandable. We also know 24/7. We know that we can see ourselves that 15% of all conversations across our platform are out of hours. So we know that is a really, really good use case. There's we've proven that. There's absolutely no doubt about that. I love the 40 million cost savings per year they got, right? So I kind of I know how many conversations we have on our platform. I was kind of looking at that going, okay, so we're probably saving our customers about $160 million a month. Based on the number of conversations that are on our platforms. So that's an interesting number. I would love to sit down with the folks in Klarna and talk through how they got all of these. I don't think they're going to humor me on that one. But it is impressive, right? It's a good use case. It certainly is impressive and just shows you where this is going for sure.
I think this is going to set the conversation going again with anyone who's in the credit industry looking to support customers. They're going to have to look at this now again and go, their boards are going to be all over them, just going, hey, why aren't we getting these savings? So I expect a big uptick in 2024 in all things customer service and conversational AI.
Can I ask you, right? And it's worth probably not now, but if they're saying it's doing the workload of 700 human agents, right, and we can only take it on this, this is what they're saying, right? you have to consider the implications that that's going to have for the contact center industry, the BPO industry down the line. Like the figure of 700, just that was the one that I kind of thought, oh, okay, yeah, show me where you came up with that. The others I can relate to. That's a lot. That's a lot.
Cormac, I've been keeping an eye on this for a while, and the numbers of people working in the UK contact center industry is around 1.3 million.
Yeah.
Now, if you take anything from 20 to 40% impact on jobs from this AI, that's a lot of people. Like that's anywhere at minimum 250,000 or 250,000 people will have their job impacted by this stuff. So this isn't an insignificant development. It's going to take some time to filter through, apparently. But look, the trend is there. You got to automate, or it's you just got to automate, or you're out of business. Basically, you have to go down this path. But there's challenges in doing that. You can see that people are like large customers are going to sit in front of BPOs and say, where's my 20% cost saving? Like if you guys were implementing this technology, like I know it can be, I'd be getting 20% off. You guys have to reduce your price to work that in. And now I'm in my next negotiation cycle. So that's going to be a problem.
Yeah, it's going to be a problem. There's no the other question you'll have to start thinking about too is, okay, if I can implement these type of savings and this type of impact, does it make sense for me to retain the collections function within my enterprise instead of passing it out to a third party? I mean, there's a lot of implications here to think through. The impact that this is going to have, because if that is true in terms of what they're saving, that's like it's transformational.
It is a big deal, but again, you tie it in with other trends in the industry, like how hard it is to recruit agents, how hard it is to retain them and train them. It's quite a challenge across all aspects of trying to get agents. So maybe the easiest thing to do is to automate the easier, low-hanging, lower experience work, and then invest in agents who can handle difficult to have financial conversations with people who are in trouble. And that is where you need real skills, real experience, and a depth of human understanding with someone else's complex and messy life. So I think that they could just be a reset of what it means to work in this business. But again, we've been in this business a ton of years. Customer service as an agent pool have been stubbornly resistant to being downsized in any way. There just always seems to be more work for people to do. And so, I think I've been on the side of, look, I think when you clear away the easy to do messages, the more difficult, challenging conversations are brought to the fore, and you get to spend more time on them. And so, I have been a little bit more on I don't think this is going to hit as hard as everybody thinks, but I'm getting a lot of information on the opposite side of that to say it could be anywhere from 20 to 40% reductions. So we'll just have to wait and see. On that topic, let's move on. Some more news from Microsoft. Microsoft, in their Copilot for Everything strategy, have rolled out Copilot for Finance this week. This is important because pretty soon everyone will have exposure to what pilots are. And in our position, in our opinion, every enterprise will have to figure out how it is going to get the right assistance to the right person at the right time, be they a customer, an employee, or a channel partner. So they are, as in Microsoft, are reporting that the average user is saving 90 minutes a week. And I'm sure we'll see more data flowing in as companies, figure out how to close their books more quickly, find variations in payments of accounts more quickly, and and a host of other use cases. But the one thing I will say about, and I'm a big fan of how Microsoft has positioned this, how they run their business and how they run their organization, and particularly in relation to AI ethics. But I'm not super convinced by the metrics coming through from Microsoft so far.
Okay, what's your concern there, Paul?
My concern is that we're just in the early days. I give you my I consider myself kind of a startup guy, being in startup for the guts of 25 years now, doing various startups. And when you're trying to do something new, you got to do something big. Like, you can't walk into a customer and go, "Hey, I'm going to give you 90 minutes a week back." You've got to say, "I'm going to give you 9 hours back. I'm going to give you 4 out of 5 days back. I'm going to automate this entirely." You got to make big impacts to get people to change. 90 minutes. I mean, it was just a red flag to me that they felt that was a good enough metric to put out there. 90 minutes a week is not great.
It's not 700 human agents as we had in the previous one, right? It's not. You're not sitting back going, "Whoa." Right. Yeah. Okay. I hear you. Yeah.
And the other thing is just, I'm hearing little bits here and there that, it's a little generic. It's like getting a pro forma letter. It's like getting a pro forma piece of advice. It kind of is okay if you don't know anything, but the minute your job kind of is something that's a little bit more complex, you're a little bit experienced, the information you're presented with really has to be on the ball.
Yeah.
And just getting you that one additional layer of granularity or depth of understanding is all the difference when you're looking at the usefulness of that piece of advice to you. So again, on the upside, I think the co-pilots everywhere kind of shows people what to expect and maybe how to use it. Like, it kind of trains people in how to use it. But again, the devil's going to be in the details of how useful it actually is, and what's it doing for you? Like, what jobs is it completely automating? What things is it keeping an eye on and making sure you don't do? All to be played for, I'm sure, but by no means over as a Microsoft is doing it, and we should all go home.
Yeah, I agree with you there.
All right, and the final piece of news from the world of AI, credit, and buy now, pay later. Found this little nugget on buy now, pay later for food shopping. It was a 2023 report called The Credit Economy, How Young Consumers Make Credit Decisions. And it found that younger customers have fewer credit cards and use buy now, pay later to not only gain access to credit, but also to manage cash flow. So when we hear about someone using buy now, pay later to get milk on a Thursday, they might be paying it back on a Friday when they got paid, or when the grant arrived. They may be buying, this is a really interesting one. They may, let's just extend the example. Maybe if they buy 12 liters of milk at once, they get a lower price per liter. So they buy in bulk, and they use the buy now, pay later to get the bulk price. And then it decreases the price per unit that they had to pay. So I only raise it again just because of that point that life is messy, and exactly how people use services is worth close study for every different type of customer, because they can be using it in significantly different ways. And that example of somebody, we were on a podcast interview last week, which hopefully will be hitting our podcast here in March, but it was about the poverty penalty again, and how much that is, right? And so when you have to buy at your local grocery store as opposed to the supermarket because you can't drive there, or because you've got some sort of physical disability that stops you from getting there, or you don't have a car, you're paying for the expensive groceries in the corner shop. That's a penalty. You've got to pay a poverty tax just to buy from your local store. And maybe this is a great example of someone saying, well, I could get the bulk product. I have to pay a bit more, but per item, it's half price. So getting access to the buy now later really gets you access to that lower price. I thought it was a really interesting spin on things.
Yeah, it's actually good to see, because, I mean, what that is saying to me is that the young consumers are making thought-out decisions about how they make their purchases, right? So if they're using buy now, pay later instead of credit cards, they're doing it because they've thought this through and said, okay, this is a cheaper way for me to get what I want here, right? I'm hoping that's what's behind this. They're doing the math, as they say, and going, okay, buy now, pay later makes more sense. As opposed to I can get access to buy now, pay later, and I can't get access to a credit card. That's different, because we spoke about this before. It's really easy to get access to buy now, pay later. Really, really easy. It's much harder, I think, to get a credit card than it is to use buy now, pay later. So I'm going to read into this. The younger consumers are becoming more savvy about how they do their purchases, and therefore they're using forms of credit that are less costly to them, and reduce the cost of purchase. I'm hoping that's what's behind this.
Well, I'm hoping too, but there are other bits that they particularly like about the service. So they also particularly like getting special offers.
Yes, correct.
Getting discounts, getting, yourself, if you were a young person, you were buying some, let's just make it up, you're buying some good, what do they call them these days, gourmet burgers, you're getting them delivered, and somebody gives you...
say that again, Paul. Good what?
Gourmet burgers.
What are they? They like...
They're high-quality burgers. They're very fancy. High-quality burgers.
Yeah.
Yes, they
Irish,
are indeed.
Just made from Irish beef, yeah.
Oh, is there any other quality burger?
I'm just checking.
That's it.
It's good gourmet burgers, not the ones that have the sawdust in them swept up from the floor. No, these are like pure quality. Okay.
I'm hearing the voice of Samuel L. Jackson in my brain. Oh, some gourmet burger. But it
actually, I didn't think about that. You're right. Yeah.
It's but like if you get a special offer for like, hey, you get a 6-pack of beer for half price, or you get a ticket to a nightclub for free. These are all attractive offers to keep you moving. Which brings us promptly to the third part of our podcast here, which is we talk about a recent report that caught our attention. And this week, the McKinsey 2023 Digital Payments Consumer Survey caught my attention. And so this is a U.S. consumer finance focused research. But what it did show is digital payments have gained and kept a strong foothold post-pandemic. Consumers were opened up to experimenting with these payment methodologies or payment methods, and now they're kind of open to it. So they are trying new forms of payments. They're trying payments online. They're trying payments in-app. They're trying peer-to-peer payments. All of these are showing shifts in use. And the thing that has happened is they have started to trust the bigger tech companies to provide financial services for them. So if I'm trusting Apple, Samsung, or another with my tap to pay, that's my money. Like, I'm going to trust them to do other things. And maybe I think I'm getting a good deal. So there's this real problem for the traditional financial services banks and companies, is that how's your trust measure versus Google and Apple? Who is your young consumer going to trust with their financial relationships? And that's the real erosion going on here underneath everything. Two other things stood out for me. In-app payments, big jump in those, and peer-to-peer transactions. Mm-hmm. Both are becoming more commonplace. And companies might really want to think about how they could provide more utility to customers, either using those or maybe figuring out a way to take some payments action back. That's going to be particularly important because the report is also showing that consumers are going to move towards using fewer digital wallets. So in 2021, they said maybe I'll use 3. In 2021, they said I might use 3. In 2023, they're saying I'll probably only use 2. 2025, I'll probably only have 1. I'll tap with my Apple. I'll tap with my Google Pay. I'll tap with my Samsung Pay. What's next? And that's, particularly true with younger users. Another part of, so again, that's going back to, it's easy to lose sight of, but I really believe all financial services companies are in competition with the big tech companies. Like it's a big competition. It's going to take years to pan out, but I'd be tracking exactly what my strategy is going to be against these guys, because Apple, Google, Amazon are all coming for your payments business. They're all coming for your checkout business. They're coming for your loans. They're coming for your late payments, the fees, all of it. They're coming for all of it.
Yeah, but they're not coming for your electric cars, Paul. They're not. They're leaving your electric car alone.
Well, right? They will, but they'll help you tap to pay for your electricity.
They'll help you tap to pay for, but hey, listen, we're not coming after your electric cars. We leave Tesla and the other guys deal with that. But look, there's no surprise here in some of the things that are coming out in this, right? First of all, convenience is key, right? So convenience is a huge driver for digital payments and peer-to-peer payments. It's just so easy. It's so convenient, right, is number one. And number two, traceability, I find really useful. Like every time you make a digital payment, every time it's traceable, right? You know where it's going, you know what you've done, it's there. Now, that mightn't suit for all types of scenarios, but, sure. When things used to be cash, you go to an ATM, you take out some money, and a clue where that money was gone. You didn't, you don't keep receipts or any of that. Whereas now, if you're contactless, you're digital, you have a record of, everything. And so I think when you combine the convenience and the traceability, you just got a killer product that's our offering, call it what you want, service. I think it's interesting around who you trust to mind your money. And I'd certainly financial institutions over the last 10, maybe longer, have taken a bit of kicking in terms of who do you trust. I'm speaking from an Irish context here.
Sure.
Things didn't go that smoothly, in 2007, 2008, right? A lot of people jumping up and down. So I think that's very relevant. Who do you trust? Do you trust your high street bank, which is proven to have failed in the past, or do you trust your tech company that seems to be around forever and a day and only seems to be getting stronger? So I think that's I think you've been calling that for a while, in fairness to you, Paul. I think you could be on the money there.
There was some other research last week on good payment experiences and repayment experiences being tied to an uplift in brand equity. So if you treat your customers really well during a repayments process, it actually builds brand equity on the main brand, so to speak. Mm-hmm. And that does draw me to another point that was in the research from the McKinsey report, which is that a significant portion of people now start their payment journey on the buy now, pay later platform. So they're in Klarna and they start their next journey on that retailer site. I think the number was 30%. That's a huge number. 30% of the people in the buy now, pay later service will start their next product search in the buy now, pay later website. That's just a mega shift. Like where people's attention is and what they're telling you they're looking for in that search is how Google makes their money. And if all that money is now going to move to buy now, pay later sites, you can see that, wow, you're going to see these buy now, pay later sites start to make an awful lot of money in advertising and cross promotion. Yep, it's definitely an interesting shift. Wherever people shift their attention, that's going to be an interesting market later on. Okay, folks, I think that was an interesting week here on Credit Shift. Lots going on as usual. Thank you again, Cormac, for joining me and being
Paul, no problem.
Giving me your reactions to everything. And if you folks want to go and check out the Webio.com website for what's going on with Webio, do check out the new interviews that drop periodically into the Credit Shift podcast. There's some really interesting people in there already interviewed and some really interesting people coming up on it. So thank you again. Thank you for joining us on Credit Shift.